Good afternoon, good morning, everyone. It's Ted Bader here from SIA Wealth. Thank you for joining us on our Wednesday webinar series. Today, we're going to talk about a market update. Colin Kaczynski is going to give us an idea of what the charts are saying. I'm going to give a little presentation and kind of talk a bit more about tactical asset allocation, as we've been mentioning, regarding the funds that we run. If anyone has any questions, feel free to reach out and fill in any questions on type in on the question tab, and we'll be able to answer them at the end. We also have Paul Vendrinsky on here, our PM, so he can answer any specific fund questions. Although this is the last webinar scheduled, we will be doing live and recorded webinars over the next couple months just to get people updated, and so we really appreciated people joining us, and I think the feedback we heard was that a lot of advisors appreciated us doing these things. It's just we don't want to have to force to do it if there's really no news to talk about. We're in the green zone. We haven't seen much of a change, as Colin's going to mention, in our asset class ranking. But when there is something going on, then we definitely will be doing either some pre-recorded or live webinars, and we'll give everyone a lot of attention. So before I get started, that was just a bit of housekeeping. But now to talk a bit about what it is we're doing. I've hit this point numerous times, is the way advisors are using the funds that SIA Wealth runs is for tactical asset allocation. And what that means is I'm going to show you here a couple of our larger fund positions and how advisors are using them. So here's where we've had a lot of comments. Some clients are upset with our performance for the year, and I really push back sometimes, and I say, well, it really matters on what you're comparing us to. So here's an example of our focused North American fund. As you can see, for January and February, we were very strong performers. Even into the end of March, because we went into our red equity action call, we were one of the top performers in its peer group for the first 3 months of the year. Where we lagged, obviously, was April. We were out of the market as the market had a very strong month, and we got back in at the end of April. And since then, we've been able to catch up to where we were in the benchmark, and now we have just slight underperformance in the North American fund. What I would stress is when advisors are comparing our tactical fund to a traditional long-only fundamental manager, yes, there's something that you can say the performance isn't there, but you're not buying our fund for the performance on a short-term basis. You're buying our fund for the tactical ability to get out of the markets when they go down. Now, this is exactly what we did. So really, it's a tale of two funds. We were a full-on equity fund for the first part of the year and for the last 6 weeks. But in the middle, we were a complete money market fund. And that's what you can see by that straight red line for the North American fund. And this is exactly why it is a complement to a lot of these long-only managers. What's happened with the Fed issuing stimulus to the tune of 5 times the amount of 2008, it really rewarded a lot of the long-only buy and hold managers. Not to say that they're not doing what they're supposed to be doing, and they are, but they are going to be holding down these dips and then riding it back up, where we're trying to get out of the way. So fundamentally, our strategy is different, and that's why it's a really good complement to what it is we're trying to do. So I encourage you to think about it in that perspective. A lot of the advisors we deal with understand where we fit in a portfolio as that tactical sleeve. What we are hearing is that their clients are upset. They're looking at some of the worst or some negative performance from some of the funds they own, and they don't understand why this isn't doing as well as a fund that was fully invested for all of April. So I encourage you to understand that we're very optimistic. As long as we're in the green zone, we think we can add value by our stock selection. And if we do go into the red zone again, we also do believe that we're going to add value by avoiding it. What we're not going to be able to pick up on, I think we've made this clear, are those quick reversals when the Fed goes off the rails and does the big bazooka to buy everything. So just to put it in perspective about where we fit, it's really the tale of two separate funds within one mandate that we run. Second one is our BMO focused fund, the Global Tactical Equity. As you can see here, this one had a bit of US dollar exposure when we went into the red zone, so it wasn't a flat line. But as you can see, we've been able to catch up to the benchmark. We are underperforming it slightly, but our goal is exactly what I mentioned before, is we're trying to, we've actually been quite pleased with how it's caught up to the benchmarks, and we are, as long as we're in the green zone, we fully anticipate to be able to outperform once we have that track record with us. Now, where it diverges is our asset allocation fund. And I'm going to address this because this is our largest fund. A lot of advisors own it as a balanced fund, and it is underperformed its benchmark. This is a conversation really not about the equity allocation of this, but about the fixed income. So as you can see, around the end of March, when the benchmark started to outperform, we went from a corporate bond allocation where we got hit in most of March. The corporate bonds got hurt pretty much, and we rotated to safety, out of corporate bonds into government bonds, almost at the same time that the Fed announced that they were going to buy corporate bonds. So you saw the benchmark bounce up because of the corporate bond rebound that we had rotated out of. Now, again, no one knows how that Fed is going to react. We're trying to de-risk a portfolio, and as such, we have a short period of time where we're underperforming. Now that we have an allocation to the equities and our fixed income is again coming back, we fully anticipate to be able to catch up and post a very strong return by the end of the year. But this is a reality. We're talking about where we fit in a traditional fund. So although short term we might be underperforming, we were one of the best funds for the first quarter, and we're trying to allocate. So understanding where we fit in a combination of different balanced funds is very important. Our final slide that I do want to mention is this is a global tactical pool that SIA Wealth has been running. It is a pooled fund, so it's an offering memorandum. A lot of the research and development that we have spoken to SIA Charts users about in the last couple of years has actually started to be implemented in this fund. So we're showing an example of what we've been doing since 2020, the beginning of 2020, and we've been able to follow our own macro indicators. We've been able to follow our own buy and sell rules, and we've been able to be a bit more nimble. So we're very excited about some of the research and development that SIA Wealth has developed using the SIA chart system, but making it proprietary to SIA Wealth. So we're more than happy to discuss this. We just wanted to get some track record to see how these rules are actually performing, and we are quite happy with the way they've been performing. But more to come on that. I just wanted to give everyone a bit of a snapshot that we are always constantly working on trying to get our system to be more sensitive, more tactile, and more tactical. So this is exactly what we're doing. At the end of the day, though, you guys are here to listen to our market update and market outlook. So I'm going to pass it over to Colin Szynski, and he's going to talk a bit more about what the charts are saying today. And again, we will address any questions at the end, but feel free to write them as we go through this. So Colin, over to you.
Thank you very much, Ted, and thanks everyone. I'm just going to make myself the presenter and we'll get rolling. Okay, everyone should see my screen, which is starting with the market update, and we'll continue on from here. So, as Ted mentioned, we remain in the green zone in the equity action call. It hasn't moved much in the last couple of weeks. It's just been holding steady, and that's in line with the overall theme of what I'm going to be talking about, which is that we've had some big swings, and now we're starting to settle back into trading ranges, and I'll speak to that a little bit more in a moment. But so far, the markets remain favorable for equities at this point in time. In the last 2 weeks, in our asset class rankings, there have not been any changes as well. International equity, cash, and U.S. equity remain the top three. Currency in the middle. Canadian equity and commodities, fifth and sixth, and bonds are still holding down last place. I'm going to speak about bonds relative to some of the other asset classes in a moment or so. The first thing I wanted to talk about is what's happened in the last week or so, where basically we saw the markets bend but not break. The June 11th, the markets got absolutely hammered. We had been on an absolute tear for several weeks, technically overdue for a correction, and then we got one all at once with a big drop in the markets. But the big thing was there wasn't much follow through after that. There was a concern that the sell-off was a Thursday. On a Friday, did you start seeing people panic or hit margin, see stop losses get hit, margin calls go out. None of that really happened. The markets took it all in stride, started to work their way back up, and that has continued. And there's still a lot of firepower is sitting behind the market. Fiscal and monetary support is continuing. The government's talking about extending CERB for more months. The states are starting to look at the same thing. The White House looking at $1 trillion infrastructure plan. The Fed is now talking about buying corporate bonds directly and not just ETFs. Although, to be fair, they said they're continuing the pace of new money. That's slowed a little bit, which I'll show in the next slide. The leaders at the Federal Reserve Board, Governor Powell and Bank of Canada new government Macklin came out yesterday and basically both said they expect low rates to remain for the foreseeable future. And here on the right, I've put the infamous dot plot, the Fed member forecasts of interest rates for the next 3 years. And basically, you have everybody pretty much forecasting interest rates to stay exactly where they are in the US through the end of 2021. And only a couple of people looking at maybe a hike or a small number of hikes in 2022, and the majority thinks it'll be flat for that year as well. The other important thing, though, is that they're also not calling for negative interest rates, not in the US, not in Canada, and that's significant as well, because at this point that's suggesting they're not seeing things getting dramatically worse either. This is a slide here from the Federal Reserve Bank of St. Louis, and this is the adjusted what we call the monetary base. And what's important about this one is basically when people talk about the size of the Fed's balance sheet, this is what they're referring to. And so what's interesting with this is that February, March, April, huge increase in run up in this monetary base in Fed stimulus. And since then, we can see it's kind of leveled off a little bit. Yes, the Fed is still putting money into the system as needed, but it's at a slower pace than what we saw before. And that's a good thing, because that's indicating that the Fed is remaining supportive, but at the same time, they're not panicking either. So that's good news. And at this point, they're continuing to basically say that they will be supportive as needed. Now, the economic reopening is continuing, but there's signs that it's going to be somewhat uneven. Encouraging news out there is that this week, U.S. retail sales bounced back 17% in May after dropping 14% in April. McDonald's came out yesterday and said that as of June the 15th, 99% of their global locations are now open. That's up from 75% on the 30th of April. So far, we're continuing to get basically a lot of anecdotal reports out there that things are slowly but surely reopening. Concerning news, however, there are some things. We've obviously had reports of new case flare-ups in the United States and China, and that does highlight that there's a potential for some localized setbacks here and there. And also that could be within sectors, as much as McDonald's has talked about reopening. This morning, there was news out from Southwest Airlines only going to sell 2/3 of their tickets through September. Norwegian Cruise Line not running cruises through September, so they're losing their summer season. So some areas are reopening faster than other areas, and this pace of reopenings can vary too. It varies from country to country, it varies from province to province, it varies from industry to industry, and even within a province here in Ontario, we have a lot of counties went to phase 2 last Friday. A few more are going to phase 2 this Friday, and still waiting for the word on Toronto. So we'll see what happens with that. But as we go forward, this notion that we had in the market of pedal to the metal, V-shaped recovery, everything will be great in a few weeks is probably not true. Things won't be as bad as they were, but we're probably not going back to where we were in January or February either. We're going to kind of end up bumping along in the middle, and so because of that, we're starting to see a bit of a leveling off in the markets as well. And so one of the questions we've been getting a lot of late is, well, what's going on with equities versus bonds? And we had some big swings. We saw that bonds had done when the equity markets were crashing in February and March, bonds had shot up and were doing incredibly well. And then that has subsequently reversed. And since the markets bottomed out in March, stocks have done incredibly well, and bonds not so much. So what we're seeing here with the overall relationship between equities and bonds is that we had so this is equities going up and down. So equities dramatically underperformed, then equities dramatically outperformed. Now things have eased off a little bit, and we're starting to shift back into the middle, and we're seeing more kind of previous ranges, sideways trends starting to reemerge, and that's a theme that we're seeing across a number of markets. It's like there was too much panic to the downside. People probably got a little too enthusiastic in the rebound, and now everybody's reassessing, and we're kind of starting to settle back a little bit as we move into the latter part of June. I wanted to highlight here the 10-year interest rate as an example of a couple examples of fear and thoughts of liquidity. So with the CBOE interest rate, the 10-year TNX had been trending downwards since early 2018 anyways. It was driven down again starting in January, interestingly enough, and it started in January, drove down, bottomed out in March. We had an initial bounce, another pullback, and so on, but the size of the pullbacks are getting, and rallies are getting smaller, and we're starting to see this trend of higher low emerge here for the 10-year rate. So what is that indicative of? Well, when the rates were plunging, bond rates were spiking. As rates bottomed out and started to curve back up, the bond prices have leveled off and started to come back down. It also suggests the panic that took hold among investors starts to be subsiding, and confidence has improved a little bit. The third thing is that this is also indicative that nobody's expecting in the long term to see negative interest rates, although the jury's still out on the short term. But really, it seems that between the Fed and this, the speculation of going to negative rates in North America is looking a little bit overblown. The key levels we want to watch for here is 0.9%. First resistance and 1.25% second resistance. Those two levels would indicate things like people's expectations for the economy are improving. They started saying the rates could start to go back up, or inflation might pick up. So those are the levels we want to watch. Otherwise, for now, we just kind of have stabilized in a lower range. Next, I wanted to talk about the VIX, the S&P Volatility Index, or also known as the Fear Index. It's basically still trending downward from its March peak. Now, last week when we had that crunch in the markets, we did get a bit of a pop in the VIX, but it was relatively contained at more recent levels. And so we can see, though, what's important for us to recognize with the VIX is that there was a range of about 12 to 22 that prevailed through most of 2019 and into the early part of 2020. Now we're seeing a range of more like 25 to 40. So we're seeing that the VIX generally has leveled off into a range that's elevated from where it was. So we're not at the extremes of fear. We're not at the extremes of complacency. We seem to be leveling off somewhere in the middle. And this is indicative of a more uncertainty in the business environment, that we're in the early stages of a recovery, but as I noted, it's uneven. It's not everything coming back at once. Some things might take longer than others, and some areas might improve faster than others. And while that all gets sorted out, then of course it makes sense that expectations and concerns would remain elevated through this kind of a period. So we could still see markets remain a bit volatile, still seeing swings up and down, but we are also seeing more ranges starting to emerge. Another comparison I wanted to talk about, I like to look at, is the Russell 2000 versus the S&P 100. So the small caps versus the mega caps, because sometimes we'll see that indices will move, but say it's only half a dozen of the largest weight stocks that are moving the whole index. And so what I like to look at this for is it tells you, are investors prepared to participate in a wider range of stocks, or are they only buying 10 stocks or selling 10 stocks? And the second part of that is that because the Russell 2000 is smaller companies rather than the mega caps, more emerging companies, companies that and so on, it's indicative that when people are buying small caps, or it's a sign of confidence, it's a sign of improving breadth. And so what are we seeing here is that we were in a fairly steady range through, that's actually as much of the last decade, and then the small caps really plunged off relative to the big caps in 2019 into March. And since April, we've seen this nice bottoming out where the small cap performance is starting to improve, becoming less depressed. So it's a sign of a willingness to take on risk again, a willingness of improving confidence and aggressiveness among investors. So at this point, though, I mean, we're not back at where we were. It's not screaming higher. So, but it's more a case of cautious optimism at this point in time. Another one I'm looking at here is the Dow Jones Transportation Average versus the Dow Jones Industrial Average. This dates back to Dow theory, which has been around for over 100 years, 120 years, where you want to see the industrials confirming the transports. In this particular case, though, what I'm looking at here is that the transports are probably the sector, one of the, let's call it half a dozen sectors that were beaten down the most by COVID-19, that were particularly impacted. Transports, particularly, I talked about the airlines, I talked about the cruise lines a few minutes earlier in this presentation, and they've really been hit hard by the lockdowns. So in the case, but in the just before we had the correction, transports were starting to come back in a big way, and we can see that in this column, in this last column of X's, that we were just starting to see all of a sudden some renewed interest in transports. Now that has since settled back a little bit, perhaps a recognition that maybe things got a little bit ahead of themselves, but still that will be a sign we're watching for, as well as do we see the transports actually start to break out. We haven't seen that yet. What we're seeing is that the transports relative to the industrials are just starting to level off in a lower range. So the relationship is stabilized. It hasn't gotten any worse for the transports, but it hasn't really reversed or started upward yet either. Again, leaving us in the situation where it's still an uncertain environment out there. Now I'm going to shift over and talk about some of commodities and other asset classes. So to start off with, I looked at Dr. Copper, which is one of the most commodities considered the most sensitive to global economic conditions. It's also been seen as an indicator of the appetite of China for resources in particular. So with its sensitivity to China, copper was crushed starting in January. It actually bottomed out and has rebounded up into June, and it had a pretty nice acceleration in the last latter part of May and the early part of June. It's had a bit of a correction, but not too much, and basically this looks like more like a pause now that it's moved back up into its prior trading range, which was about 250 to 285. Crude oil had an incredible run. It started to fall off a cliff back in January, and then had a second round of retreat in April until that was all finally flushed out. And then since then, the oil market has come back pretty strong, rallying from the low teens all into the high 30s between late April and the early part of June, so about 6 weeks. The things that crushed oil was the first round was the demand side, that people started to recognize that COVID-19 could hit energy demand, and that took the oil down, energy down the first time. And then the second round was when we had the supply side, when OPEC Plus couldn't agree on extending their production agreements, and it looked like they might be heading into a supplier war. Now, the OPEC Plus situation basically has been resolved. They've been agreeing to a new agreement, deeper cuts, extend the agreement, crack down on cheaters, and so on. So now the real focus in the energy market is on the pace of demand recovery. I talked about transport. So transport certainly is an area that has high, that is a big chunk of demand for crude oil. So it's how fast do travel and transportation come back? How fast do other parts of the economy come back is really quite important here for the future outlook of crude oil. We've gotten up towards 40 and kind of running into resistance. There's a big resistance level with a downtrend about the 44 level. Initial support somewhere in the low 30s, 32, 33, something like that. The next one is gold, and gold is quite important. Sometimes in the shorter terms, it'll trade similar to the VIX, where it goes up and down with fear and capital flowing into defensive havens and back out. And but the other thing that gold has behind it right now is this ongoing easing by central banks, the new monetary stimulus, all those measures that devalue paper money and put a tailwind behind the gold price. So we've seen this is a 2% chart. So we've seen gold although it's paused, has not really had a sizable correction in any stretch. It came off from the high 1700s down to about 1700. So it's not even 5% correction, and gold has actually held in extremely well. And that's indicative of the fact that investors are just recognizing just how much money the central banks are printing these days. So there's some initial support around 1700, more around 1650. The upside we're looking at is 1800 to 1820, back up at these previous highs that date back to 2011, 2012. But at this point in time, as long as the central banks continue to do asset purchases and essentially print money, the gold price remains in an uptrend. Wanted to talk a little bit about Canada as well. We've seen with the TSX Composite has had a nice recovery, but it has been lagging relative to the asset classes. It still only has a 5 S-Max. That's compared to like a 9 and a 10 S-Max for gold and for crude. It's been has come up to an old downtrend line where it's started to struggle a little bit. We may be seeing a sideways range starting to emerge for the TSX, and of course it's sensitive to energy and metal producers. So for example, some of these moves up were related to rallies by gold stocks. Some have been related to rallies by energy stocks, and as we see them swing up and down, certainly has an influence on the index. But one sector I wanted to talk in particular about that hasn't been discussed really in Canada in quite some time is the financials. On a relative strength basis, the banks and the insurers have not done much. They were hammered with the rest of the market back in the early part of this year, started to sell off in February, bottomed out towards the end of March, and even when the TSX was starting to really come back, being driven by energy and mines, the banks were just kind of holding steady through April and really through May, and so it was a sector that was lagging. Banks started to pick up right after they finished their earnings reports, and that was when we didn't see it. We only saw one dividend cut from the banks, and that was Laurentian. We saw overall the increases in loan loss provisions. That was pretty widely expected, but overall, though, after earnings came out, there was the street took a little more interest, and the banks and even the insurance companies did start to pick up. We've had a correction and a retest back to the breakout point, so we'll be looking now to see, does that continue to hold and the banks start to remain in this higher range, and pick up from here, or do they continue to slump back? Remains to be seen. But I did talk about the S-Max score of the TSX relative to asset classes at 5 and lagging a little bit, but for the banks it's actually at 8. So we have seen some relative improvements in the banks of late. Final chart I just wanted to highlight here is US dollar CAD. Earlier this year, it was a US dollar story. The US dollar took off against everything when we saw capital come out of, everybody fled into the US, fled into US bonds, fled into US cash, and that drove up the US dollar against everything, including the Canadian dollar. We saw that settle back a little bit, and now we've seen another leg down where the Canadian dollar is recovering against the US dollar. There's a few factors in that. Capital has started to come back out of the US as confidence has improved, and people are seeing perhaps not quite as much of a need for the US dollar as a safe haven. Even relative to things like gold, which is held up reasonably well. The other thing, of course, is a recovery in the energy prices has also helped the Canadian dollar to come back as well. And on that note, that concludes my comments. I guess, Ted, at this point we can open the floor for questions.
Yep. So if there's any questions, please type them out in the question tab, and we'll get to them. I did have a first question, Colin, regarding the asset class ranking.
Yes.
We haven't seen any changes there. Is there any comments on that from, I guess, the international to cash being number 2 to US is 3rd and bonds last? Any comment on that? I know I get that a lot from advisors.
Sure. I think at this point in time, it's just an indicative of the relative relations between asset classes has started to stabilize, and that's what I was kind of of talking about at this point in time that, that things have just all kind of leveled off relative to each other. We're getting a little bit of almost kind of a mean reversion, but at least not a huge reversal, but more of a leveling off at this point in time. And that's what we're seeing with the asset class rankings. We had these big swings and big changes in the relative performance of a number of asset classes, and now things are kind of stabilizing. And what I'm thinking is, as we look ahead, is that things may stabilize for it could be even a month from here, because it's a month until earnings season really gets going. And that's when we'll start to get an idea and we'll perhaps more sorting of which companies have bounced back quickly in this quarter, which companies were still being hit hard, and how is that all shaking out, and what are things looking at as we start to move into July, August, September, when more things are reopened. If we think of the first quarter, most of the lockdowns, especially in North America, didn't really hit until the last 2 weeks. So this quarter, the second quarter, is really the big impact quarter where we were pretty much locked down for April and most of May, and June has been more tentative. The reopenings depend too aggressive depending on where you are, and then in the summer we might start to see more things bouncing back, and then we'll get an idea of how much of a bounce back are we really getting, and what is sustainable and what is a short release of pent up demand. It was quite interesting. On the weekend, for example, I was out. I went out shopping, and I was at like places like Canadian Tire, and that had been closed for a while. Now there's a huge lineup at Canadian Tire just to try and get in, even on a Saturday night. When you think, well, nobody goes to Canadian Tire on a Saturday night, well, you'd be amazed. When now and that says to me that at least some things are starting to see that there is a demand out there. We'll see what happens as more places reopen.
Okay. The next question is going to be for Paul Vendrinsky. It came in, and it also relates to another question I had regarding sector allocations. We talked about a couple of webinars before how it's important to be in the right sectors at this time. So Paul, if you can make a comment on that, and the question out there, is there any changes in the underlying holdings of our North American equity fund? And I think that might relate to some sector weightings as well. Can you address that?
Sure. Yeah. Thanks, Ted. I can. Yeah. I think looking at this as a sector approach is a little easier, and it's not just actually the North American fund. Some of our other funds, we've seen a little bit of rotation take place since we've moved back into the markets in late April. A couple of things I can say: in late May and early June, the biggest sector rotation was really out of the precious metals, specifically gold equities, and unlike the commodity that Colin was just showing, that they don't necessarily or all the time move very correlated. So we did end up rotating out of all of the gold names within the North American, as well as some of the other products. What we've moved into is, a wide variety of different sectors. So it's kind of split up, and we have had a little bit of sector rotation in some other areas as of recently. Since these were so recent, we can't really comment on what was moved out and what we've moved into, but there's been a little bit of turnover recently, but the most substantial has been out of the precious metals for now. And if we see continued strength come back into the equities, it's possible that we can rotate back in them. But originally back in April, that was more of a hedge or a risk management play as far as what ranked high at the time. I should mention too, of course, the quarter ends in a couple weeks here, so more specifics on what has changed in the portfolios will be disclosed in some of our commentaries and our quarterly reports also. Mm-hmm.
We did have some exposure to some energy, and how that. Any comment on that energy sector in terms of kind of still a favored, still a favored sector according to us?
Well, yeah, most of the sector or energy sector exposure we did take in various different portfolios took place when we did that move back in the end of April. Some of them have done very well since then. Recently, we've been seeing some pullbacks, a little bit of weakness in some of these names after such a huge move. So as of today, yeah, we still have exposure to certain, mostly Canadian energy names, Ovintiv and Cenovus. to name two that were brought in back then. And you know, before we bought into them, they did quite a rebound. So we're catching the tail end of it, but still seeing a positive unrealized gain for both of those currently.
Okay. Good. All right. Well, there's no more questions. So we're going to wrap it up for today, but thanks again, everyone, for joining us. Like I mentioned, we are going to be posting live or recorded videos and webinars over the next couple months. We like this kind of forum, and we've heard some pretty good feedback, so we want to keep it going. I just don't think doing one every week or every other week is going to be the best use of everyone's time. We want to do it when there's something specific to talk about. So thank you, everyone. And if there's any questions, feel free to reach out. We're more than happy to help in any way possible. Thanks, everyone, and have a good rest.